So picking up from the previous week, this week we are looking at who the shareholders are, and that leading us to the question is how does that influence corporate governance? Now there's been quite a change in who shareholders are. Berlin means historically and very famously made observations for a world where there were individual shareholders. So those were people like you and me invested in the stock market owning shares. And their observation was that there had been a separation of ownership and control, whereby the shareholders did have ownership rights, but didn't use those because they were rationally inactive, because their involvement wasn't worth the effort. Now we have moved very far from this into a world where the majority of shares are owned not by individuals, but, for example, through pensions. And once you open the pension box, you realize that there is different types of schemes, but for each of them, there are various participants that make decisions. So you get trustees, you have advisors. Advisors help trustees to identify which asset manager to appoint, and asset managers are the people that make decisions about what shares or what fund to buy. And then there are custodians, and these are other service providers that look after assets. There's also a different distinction between defined contribution and defined benefit schemes. In defined benefit schemes, the employer bears the risk of a negative outcome, and in a defined contribution scheme, the employee does. So takeaway here, we've moved from individual shareholders to institutional shareholders. One example, a trust-based pension scheme. Another example, a contract-based pension scheme. Here, perhaps worth highlighting that there are no trustees, but there are independent governance committees which oversee the investment, and the aim is that they ensure that the investment is carried out in the interest of the beneficiaries. Mutual funds are another example. Then we've got charities and endowments. So these are large portfolio investors which have quite a bit of money to invest, and there's also a range of participants for them. Hedge funds and sovereign wealth funds are other examples. So the first three slides there, slide 2, 3, and 4, show examples of institutional investors. For all of them, when they choose an investment, they make a decision on a strategy. And there are a number of strategies. One strategy is an active investment strategy, and that is where an asset manager uses his skills or her skills to identify which investments to buy, which investments to hold, which investments to sell. And Neil Woodford, who in the autumn was in the press quite a bit because he used to be a very successful fund manager and then had some problems. Then there's a passive investment strategy. Those are index tracker funds where the asset manager doesn't decide what to buy on an ad hoc basis, but a predefined index is used to identify which shares to buy. And then there is something new, AI-based investment strategies, where an algorithm either assists an asset manager or selects investments. Question is, how do these affect governance? Well, one way to sort of approach it is to say, for active investments, governance isn't really a topic because they can buy and sell as they wish. For investors that have a passively tracking portfolio, perhaps for them, getting involved in governance is a good idea because they can't change the makeup of their portfolio, but they could improve perhaps performance through being actively engaged. And something similar might apply to AI-based investment strategies. So the question is there a connection between the way you choose your investments and your inclination to exercise your governance rights? And if you look at the literature, the answer is, well, perhaps, if anything, passively tracking investors have a slightly greater incentive to engage actively. But that's, of course, set against the background that there isn't clear empirical evidence that engagement actually improves return for investors. There's empirical literature that goes one way and empirical literature that goes the other way. But in any event, that's a question. Now, moving on to service providers, and here we come to sort of the heart of a problem. There are a number of service providers that assist, in particular with pensions, but also with for other investors. So there's a group called investment advisors to trustees. There's asset managers, as I've said. There are transfer agents. These are service providers that record who owns what fund. They're custodians who record who owns which assets other than funds. And then there are proxy advisors. So those are people that advise on governance issues. So they help investors to choose how to exercise their voting rights. So what you can see here, there's a fairly high degree of specializations. There's a sort of significant, sort of fairly large number of providers, and they kind of contribute to this industry. Now, here is a sort of an area that I've researched quite a bit, and that's the question of how do the custodians work? And very often, investment isn't held directly, so you don't have your ultimate investor holding the securities in their name. Very often, they hold it through a fund, and the fund then has to have a custodian, and sometimes custodians use sub-custodians and sub-custodians until they get to the central securities depository, which is where the share is recorded. So what you see here is that it's not straightforward in terms of the investor has a view on how the company should operate. If the investor has such a view, they would have to talk to their fund, and the fund is unlikely going to be interested in engaging with them. So the decision making probably happens here at the level of the fund, and the fund, or rather the asset manager who acts for the fund, would then have to send their votes through this chain of custodians, usually with the help of another service provider. Sort of voting agents help there, and make sure that the vote reaches the CSD. So what I'm saying is that voting is not a matter of individual shareholders taking a view. It's more an institutional framework through which a view needs to be formed that then needs to be communicated, and that complicates matters. The implications, therefore. So what has happened in the K review says there has been a transformation of long-term interests into short-term signals. And that's because the pensioners, pension savers, you and me, we have long-term interests. But what happens is we employ trustees who appoint fund or asset managers And those fund or asset managers are reviewed against certain criteria, but those are short-term criteria. And at that point, my and your long-term interests ends up being a short-term interest because the asset manager feels they have to report good news constantly in the short term. And that means that they want good news from issuer companies also in the short term. So there's a sort of problem there. And then there's another question that arises from that is who owns an economic interest in shares? So that's a question that we won't very much talk about. But of course, from the perspective of issuers, that's useful to know. And there are special transparency rules. Implications that we're more interested in are operational problems. So voting is difficult because, as I've shown in this previous slide number 7, the votes have to be processed through that chain. Proxy advisors help with giving advice on how to vote, and proxy agents channel the vote through that chain. Then there is an issue in relation to securities lending. So what happens is that custodians sometimes ask funds if they can lend their securities, and when that happens, voting can be difficult. Another issue that we have is that there's a kind of a dilution of value because there are multiple agency conflicts. So each of those participants in that market has their own self-interest, which doesn't line up with the client's self-interest. And so all those all those conflicts of interest accumulate, and then value seeps into this chain. And then another implication are the fiduciary duties of trustees. That means for trust funds, let me have a look. Where is the trust fund slide? Yeah. So the trustees here in a trust fund need to decide on an investment strategy. With the help of an advisor, they need to put together a mandate for an asset manager. And their duties are defined as duties in terms of financial return. So they need to look after the financial return for the beneficiaries. And that skews their ability to take into account factors that are not about financial return. So for them, the question is, do we want active engagement with issuers? And the answer is yes, if it enhances financial return. Or do we want financially sustainable forms of investment? And the trustee would have to give the answer yes, provided that it doesn't compromise financial return. So then the question is, over what time period? Well, that depends on the liability, the obligations the pension arrangement has towards their beneficiaries. So there's a very big question there about, or rather a big problem about the fact that on the one hand the government would like responsible investment, on the other hand trustees who are at the heart of the decision making on how to invest, and then after they've made that decision on whether or not they want their service providers to be actively engaged with issuers or not, that then depends very much on their view on whether that generates financial return. So solutions then. The Stewardship Code, this is a video that shows the approach of the government. It's worth watching. So the Stewardship Code is a solution. The Stewardship Code, or a solution that the government hopes will encourage a responsible attitude by shareholders and their representatives. How does it operate? It operates, and there's a new code, by the way, Stewardship Code 2020. It operates on an adopt or explain basis. There's disclosure, and the idea is that the beneficiaries and the end investors will, based on that disclosure, exercise some pressure on their pension trustees to be responsible. Responsible in two ways. Responsible as exercising their shareholder rights, but not only just exercising them, but exercising them in a way that promotes long-term sustainability. So the idea of the Stewardship Code is the people who sign up to it, trustees and asset managers, for example, are encouraged to vote in a way that is responsible for the long-term benefit of the issuers, but also the economy as a whole. Now the question is, which market participants would ask for stewardship? Well, those are really, it has to be end investors and beneficiaries, and there, that's a difficult case to make, because and that's now in an article that's on the essential reading list. The question is there a financial incentive? The empirical literature isn't conclusive on that. The empirical literature doesn't sort of conclude, yes, generally stewardship engagement is good. The evidence is rather mixed. So the question then is are there other motives, non-financial motives? And the answer is yes, for some. So, for example, the Church of England has adopted a responsible investment strategy. The Duchy of Cornwall has. The Norwegian Investment Fund has. But otherwise, the sort of Stewardship Code tries to encourage responsible investment, but that's all it tries to do. I won't go through the role of individual market participants. Now, the Stewardship Code on the whole isn't very effective. We'll see what the new hasn't been, the previous versions haven't been. We'll see what the new code does. But the question for us to ask here is, would it make sense to have a regulatory duty requiring asset managers to exercise voting rights? Would it make sense to have a regulatory duty or further clarifying the duties of pension trustees, giving them more scope to integrate responsible investment and sustainability, or perhaps have a rule that links tax benefits, so pension credit, to stewardship active products. And then another solution would be perhaps loyalty shares. So the overall question for you to think about here is, first, understand the problem of an institutionalized form of investment, meaning the fact that shareholders are institutional investors where the market is fairly, so there's many of them, they each have their specific roles, and there are many agency conflicts in that area. And then going on from there, how do we, against this background, make sure that shareholder rights are exercised? And next question, how can we make sure that they're responsibly exercised? And then also, of course, are things fine the way they are? Is it not necessary even for shareholders to exercise any rights? So you could take the view, this is the situation, this is a market's situation. The market has created this structure. There's no incentive for shareholders to exercise their rights. There's nothing wrong with it. So that would be a sort of hands-off approach. And And then, of course, you could adopt the opposite view to say, yes, there is very little shareholder oversight, but that is a problem because it deprives directors of oversight from investors. And so you need to take a view on where you stand on these issues.